Hello, everyone. It's about noon here, and give it a couple quick seconds here to let everyone file in. Welcome. It's that time of the year again, tax time, good times. Thanks for joining me. And as you can see, we're here to talk about 5 ways you could reduce your 2021 taxes. I'll be honest with you, it started as 5, and there's a few more in there. But really the idea behind this webinar is to not only help you with some of the ways you might be able to reduce your taxes, whether it be this year while you're filing the 2022 season or in the future, but also just some tips on how to go about paying your taxes, things to look for, some tips about things to look for in the mail, and just really making sure that we do everything we can to help you through the process and make some of the decisions you have to make. For those of you who don't know me, my name is John Williams. I'm with Bautis Financial. I'm the lead advisor at Bautis Financial, and I think one of my greatest accomplishments is being the father of 4 boys. 2 sets of twins on the age of 5. So if I look tired, it's probably because I am. And I really think these things should have a laugh track behind them, just to make myself feel better. But yeah, I've been in the industry about 5 years. For those Falling Down fans out there, I host a podcast called Clear Path. And I really want to first, before I got started, invite you to check out our webpage, our blog. This will be posted in the webinar section as a recording after, if you want to return to it to reference. But there is a wealth of different resources. We work really hard to put a lot of content, really great content out there. So if you have any questions regarding your finances, it's almost certainly addressed somewhere on our website. So I invite you to go there and check that out for sure. And without further ado, I think I'm going to get started. There's going to be a lot of information at the end. I'll be asking anyone if there's any questions out there. So before we get started, let's keep our lawyers happy. Throw the disclaimer out there really quickly. And I will also say I am not a CPA. A lot of the things we're going to be talking about today are accounting related. We work really hard to make sure they're on top of everything that could be possibly beneficial for our clients. But when it comes to something that might be something you're unsure about, we definitely recommend reaching out to a tax professional. And in the beginning, one of the biggest decisions people make when they're filing their taxes is how they're going to file. More than 80 million taxpayers pay professionals to do so, and paying a professional is not for everyone. It's not necessary, and there is a fine line between doing it yourself, hiring somebody to do it for you, or looking at some of these services. So I just really wanted to quickly go over some of those different options and help you through some of that. And of course, there's costs involved, so you have to do that cost benefit analysis to make sure that you're making the decision that makes the most sense for what you're paying for. I like the analogy when I talk about this as changing the oil in your car. This day and age, you can go on the YouTube and pretty much find an instructional video to do anything, right? And changing your oil is no different. Most of us here could figure it out, right? And probably save some money. But at the end of the day, do we really want to spend the time doing it? Are we worried that we might mess something up? Is it just easier and faster for somebody else to do it? So, I don't, then when it comes to the car, there's changing the oil, but there's also something like fixing the engine or, something way more complicated in the car. And, that really there's that changeover, like where you might consider changing your oil. If there's a gasket that has to get changed on the head of the car of the engine, you're probably going to bypass looking on YouTube to try and get that done. So, there really is going to be that crossover. And some of the things that I think that are worth considering is really just at the highest level, the complexity of your situation. How complex do you feel your situation is, or is it just very simple? How do you earn your income, or does your income get reported? Is it W-2 through your employer, or or is a lot of it coming through 1099, or you're a business owner? So that's a big consideration, as you can imagine, with a W-2, and there's only W-2 income. It's a way simpler than if there's 1099 and sometimes some expenses, which I'll get to later. Are you a business owner? Like I just said, obviously that's going to be almost two different entities, and as you can imagine, the business is going to overlap a lot with your personal taxes. And one of the big things I'm going to get to is standard or itemized deductions. That is related to the 1099 and the business owner. And in most cases, if you're W-2, you may not need to itemize or really see a benefit from itemized deductions. And I'll go into more detail there. Do you see a value in building a long-term relationship? Do you see a value in having that person that you can turn to that knows your situation? Do you see your situation may not be complex now, but is important for you to lay down that groundwork because you see that it might get complex in the future? And is the purchasing of the tax accountant, which I'm going to go to a little bit into price really quickly, and do it yourself. Maybe it might just be a less expensive option, and really just considering those different software and whether you've used them before, and how familiar you are with those types of softwares and how comfortable you are. Really at the end is really what we're going to be looking at, is how comfortable are you with these things, and how daring are you to kind of like jump into doing it yourself or working with one of these services. These are some of the different services that are out there that I pulled together. Some of them run from free up to, there's as you see at the bottom, Jackson Hewitt is upwards of $249. Now, as you can imagine, there's probably different services. The higher end services might give you access to a tax professional if you have any questions, but as you can see, they're fairly affordable, when it comes down to it. And some of them are even free for those really, really simple situations. And I think that there's data that you're filing your taxes with a tax professional. Really quick point on that, can run you anywhere from $200 all the way up to thousands, depending on how complex your situation is. And the lowest that we found is in that like $150 to $200 to pay somebody to do it for you. And as you obviously go up in price, it's going to be based off of the complexity of your situation and the accessibility that you have, and the amount of time that the professional is going to be working with you on a consultation basis. So next, I want to talk about standard versus itemized. Now, this became a really big issue really back in 2017, when there was a lot of changes that happened with the Tax Cuts and Jobs Act. And the standard deduction really became front and center from itemizing. It used to be the standard deduction used to be $4,050 per filer and child. So if you had a large family, or if you had a couple kids at home, and it was you and a spouse, you're looking at north of $18,000. That was also was increased significantly if you were in a similar situation. If you're married and filing jointly, they raised that up to $25,000 to sweeten the deal. So that was also coupled with the idea that they changed some of the they put some caps on what were normally some large deductions, like the SALT, which is state and local taxes. That was capped at $10,000. And they also reduced the amount of mortgage interest you could write off. And they capped that at the first $750,000 of your primary home. So really, if you are in a situation where you have high state taxes, which a lot of the people in the Northeast who might be part of this here are, that cap really put you in a situation where you'd had to really look hard at how much of some of these deductions were going to be beneficial, and how many of them you could pull together. Because ultimately, if you're married filing jointly, you need to get to that $25,000 really for it to $25,100 over that as far as deductions, itemized deductions, to make it worth it. Two of the other things that are going to be like some of the larger itemized deductions that we see out there are medical and dental expenses and charitable contributions. So really, in most cases, unless you had a year where there was a medical event and a large amount of charitable contributions, most people are going to be looking at that the standard deduction. And the other part of that too is if you own a business, you're almost there are going to be some factors there, and that is almost a whole different webinar in of itself. And quite frankly, if you're owning a business, you're probably almost always going to be working with a tax professional at some point, and they're going to be helping you through those expenses. So, and like I said, so it really comes down to is what's higher or lower, that standard deduction number or the itemized number. And it really does come down to, in many cases, looking at any high medical expenses or charitable contributions that you made in that year. Now, at this point, a lot of our clients are saying they have this pile of the stuff that's coming in. You have your pile of your 1099s, your W-2s, all those important documents. And we put together a list of some of the important documents you're going to want to look out for. Just so you know, after this webinar, I'm going to send an email out to each one of you and give you a list of these things that you can check off your list and keep an eye out for. And also, which I'll get to towards the end, is I'm going to send out an important, I guess, limitations or AGI limits on a lot of the stuff I'm going to talk about here. So I'll get into more detail about that. But really, you're obviously going to want to be looking for those W-2s, the different 1099s from investment accounts, banks, anything with interest, your mortgage interest, and pull all those things together. So we'll send this over so you can check through and remind yourself some of the, it's really easy to kind of overlook some of these things. So you're going to want to make sure that you have a comprehensive list when you finally do sit down to do it yourself with one of these tax services, or send over your paperwork to an accountant. One of the biggest changes this year was this child tax credit. The American Rescue Act changed or increased the possible credit amount to $3,000. Well, it was at $2,000 as a max, and that increased to a possibility of $3,600. It was $3,600 for a child under 18 and over 6, and $3,600 for a child under 6. So the limit was changed from 2,000 to 3,600. Now that additional possible $1,600 or $1,000 has its own phase out. So this whole increase, or the child tax credit, as we're looking at it from 2021, is going to have two phase outs. So for the increase, the phase out is going to be $150,000. It's going to start at $150,000 for married and filing jointly. Filing as a head of household is $112,500, and $75,000 if you're single, and filing a separate return. So and that will phase out to the $2,000. So that if you have one child between the ages of 6 and 18, and you make over $170,000, you're most likely going to then be at that $2,000 limit. So basically that increase has its own phase out. From there, you're going to have, it's going to basically go back to where it was before. So, and the phase out started for a family, a married filing jointly return of $400,000. So now, if you phase out of that increase, you start to phase out at $400,000 and $200,000 for all other filing statuses, which of course would include, single and a single filing. Now, at that point, if 400,000 to, I think it's roughly about 420,000, that $2,000 would then phase out. Now, the other thing that actually occurred, and it was funny, I was talking to clients, a couple of clients, and they're like, yeah, this money just popped into my account. And, when if you're busy and you weren't like on top of the news and didn't realize that there was this advanced payment part of this of the credit from July until December, these payments started popping up. But basically, what the act decided, or they had decided with the act to implement the act, was prepayments of what the credit would have been on your taxes. So what that really looked like is they based their estimation of what they thought you were going to be receiving for your tax credit when as part of your 2021 tax filing, based off of your 2020 taxes. So what they did is they looked at your 2020 filing. They said, okay, we think that this household person is going to be due X amount for their 2021 tax credit, and then they took that amount and they cut it in half, and then they broke that out into the 6 months and sent you a payment every month through December of last year. So if you're receiving those, that's ultimately where they came to that. But I have to say that there was some really strange numbers coming through on some of the people I spoke to about how much they were getting. So you will, in any case, whether you feel like that number lines up with what you were receiving or not, you want to look for this letter or form 6419. It was if you received it, it's small. It says form 6419 at the bottom. Basically, this letter pointed out to you the amount that the government paid you in advance. Okay. And the reason why this is important is if you did indeed receive half and your situation and your income didn't change as far as phasing you out in any way, then you are owed the other half credit on your taxes. So this number is basically going to be the form you're going to bring to your taxes to then rectify the tax credit. So for instance, if you have one child and they estimated that you got $2,000, they sent you $1,000. Now they would send you the 6419 pointing out that they sent you $1,000. You'll then bring that to your taxes and file that $1,000, and then you will get the extra $1,000 credit. Like I said, if your situation doesn't change. So not a pretty complex situation and a lot of layers, but ultimately the takeaway here is look for that form 6419. If you can't find it, there are ways to retrieve it online. Just know the amount and just make sure that you're getting the entire possible credit that you could. The other thing that a lot of people don't realize is typically if you are taking a standard deduction, in the past, you would not be able to write off any charitable any charity or charitable tax deductions. That would typically be part of an itemized deduction, but they did, and you can, of course, if you do itemize, you can write off any charitable tax deductions. Sky's the limit. But when it comes to standard deduction, they do allow for $300 a deduction for single filers and up to $600 for married filings only. So if you are going to take that standard deduction and you remember any donations, any charitable tax deductions you did throughout the year, definitely bring those to the table. And it is a below the line deduction, but it's a deduction nonetheless. It will reduce your taxable amount. One of the next thing I wanted to point out was and really there's two here that are related to education, the lifetime learning credit. There are phase outs involved with both of these. But if there is, someone in the household with post-secondary education involved in post-secondary education, or really ultimately what that is after high school, the maximum you're due a maximum credit of 20% up to $10,000 or $2,000 as a max. This does have a fairly low phase out of $59,000 to $69,000 for singular filers, and really not that low. I mean, $118,000 for a single filer, $118,000 to $138,000. Now the second education related credit is going to be this American Opportunity Credit. This one has a much higher phase out. It is a credit that you can claim up to 2,500. And that 2,500 is going to come from the first $2,000 you get full credit, and then the second 2,000, 25% of the second 2,000 for a total of 2,500. That phase out for a single filer will begin at 80, end at 90, and then for the married filing jointly 160 to 180. So something I definitely think there's a lot of people who overlook this, who make in that 160, 180, they might think that, oh, well, this is probably not really an opportunity for me. And like I said, I'm going to be sending you a list of all these different phase outs and a list of the documents at the end. So these will all be on there, and I'll go into a little bit more detail about how that looks here in a second. The other consideration is student loan interest. So you can deduct up to $2,500 of interest paid. Of course, there's also a phase out with this, and the single filer is 70 up to 85, and the married filing only is 140 to 170. So if there is some student loan, if you are paying some student loans, make sure you check that the modified adjusted gross income, and see where you are with regards to that phase out. One of the things that I do also want to look at is a lot of this is a good time for you to not just look at how can I help my taxes now, but doing an analysis on your past taxes and the taxes that you do that you're going to be filing here in the 2022 season, and look and put together a strategy and see if there is anything that you could be doing that you can plan for, that you can look ahead to, like, okay, what was my situation now? And some of those things that you're going to look at. One of the things, and for our clients that are here listening, you know that we do this full analysis for you, and just doing this analysis on these different levels and what is actually part of your income, it can really help you understand some of the things you're going to be doing, can be doing in the future. One of the big things is if you have an investment account and you see, so here I put this example out there, as you can see here in if you look on the right column there's STLT capital gains, that's short-term and long-term capital gains. Those capital gains can come from a handful of different places, but many times if you have an investment account and as an example, let's say you have a mutual fund in there and you get a 1099 from the investment company from that mutual fund, and the gains that came from that mutual fund. Many times those gains can come from a high turnover ratio, just as an example. And what that turnover ratio is that manager who's managing that mutual fund is selling assets within the actual mutual fund throughout the year. And that selling actually generates a capital gain, where if you have to contrast that with a mutual fund that has a very, very low, if almost zero turnover ratio, they're not selling anything. So you can actually have an unrealized gain in that mutual fund and not have any short-term or long-term tax capital gains from it. So I guess the key takeaway here is if you're not careful or you don't understand how to manage tax within an investment account, or if you're selling some stuff without understanding what short-term and long-term capital gains are, you can put yourself in a position where you're paying more tax than you really need to. So if you notice that you're getting some of these 1099s from investment accounts, give us a call, let us know. I'd be happy to take a look at them for you and help figure them out for you and kind of give you some insight into why you're getting this tax. And then the other part of that is dividends. So if there's going to be a dividend rate, historical dividend rate on like any of the assets that you invest in, whether it be mutual funds, ETFs, and that will trigger those dividends that in the 1099. So just a quick example of some of the things you can really look at and make sure that if you do see some of these capital gains arriving in the mail, especially 1099s, it could be a great possibility for you to reduce your taxes next time and plan better as far as the taxes are concerned in those investment accounts. The other part of the analysis we do is going to be just doing a run through of all these deductions and phase outs that we talked a lot about already. So as you can see in here, there's the lifetime learning credit, and really just kind of give you an idea. Hey, give you a report and say, hey, this is where you're at based off of your AGI on all of these different opportunities for credit and deductions, and really just have an idea going into your taxes. So for instance, what we do is we make sure that our clients have a copy of this going into their 2022 tax season from their taxes last year, just to see if they didn't, maybe they missed something last year, or just so they have a real clear idea of, I want to make sure that I'm looking at this. Because as an example, with the lifetime learning credit or the American Opportunity Credit, you might come to that point in that tax planning software. They might ask you, hey, all right, like, do you have this, or do you have that, or do you have the amount of interest you paid on your student loans, and without knowing whether you qualify, or it might just be something that's on your radar, you could overlook it. So if anybody here wants, that's not a client, would want us to do an analysis for them, please let us know. We'd be happy to do that for you, free of charge, of course. And then one of the things that the two of the really big ones are going to be these above the line, what they call above the line deductions. And what those are going to be is ultimately what above the line and below the line means is above the line deductions are going to reduce your AGI. Okay, and that AGI is going to be where these phase outs are going to actually be affected. Below the line will actually reduce the amount of taxes you pay, but it will not reduce the AGI, especially when it comes to looking at the different phase outs that you're seeing here. So of course you want to take that deduction if you can, but these are great because you save on your taxes, but you also will reduce the phase out, the AGI, and possibly help your situation with regards to some of these phase outs. So one of the big ones is maximize your retirement contributions, and of course, if you have a 401k, that's doing everything you can to get as much money into those accounts, because that will reduce your AGI. Of course, you have to do that within reason, because you need to pay the bills. You need to make sure that you're taking care of your household expenses. One of the things I will point out is that if you have some money saved, and it's okay to actually if you're in a situation where you want to save taxes, and you have some cash that you want to invest, and let's say it's a couple, or one of you, or even a single filer that is not maximizing their 401k contributions, then you can instead raise the maximize or raise the amount of money you're putting into your 401k and spend the savings that you have. So this way you can kind of indirectly get that money invested into the 401k, and the more you put into that 401k, the more you're going to reduce the above the line phase out numbers, the AGI, and actually reduce the amount of tax that you're paying. The second big one is FSAs and HSAs. Now, the FSA, it's going to take on different forms, but do some research, find out what you have. If you have this if you're where you work, you have this available to you, and the different ways and the different qualified expenses, and make sure that there's not something you are paying for that you could put into this FSA and then use to pay for that expense out of that account. The best example is childcare. Some employers have a childcare FSA. Now, and there's going to be limits on these, and of course find out what the limits are. But let's say you're going to be spending an X amount of dollars on sending a child to a daycare center, and that the amount you're going to be paying throughout the year is more than what the max is on an FSA. What you're doing now is like you're just putting the money into that FSA, and that's money you never pay tax on. So the money goes into that account pre-tax, and then it goes pay for that expense without paying taxes on it as well. So it's a great way to reduce taxes. Same for the HSA. If and obviously the HSA is even better because the FSA is use it or lose it. The HSA will roll over into an account. But the other side of the HSA is you do have to have a high deductible plan, and you want to make sure that the high deductible plan fits with your needs as a family. But if it does, it's a great way, again, money that you'll never pay tax on again. The money that rolls over, you can use in retirement for expenses, and you'll never pay tax on that again. So something that definitely 2 things I recommend considering. This is that key financial data card that I spoke about earlier. It'll have all those phase outs. It'll have all the key information you're going to want to look at when you're filing your taxes. And we'll get these out to you as soon as we can post webinar here. And just really great tool for you to have if you're sitting down to do your taxes, and really, even if you're going to be working with a tax accountant, something that will be, I think, really helpful to look at. And that kind of brings me to the end here. To see if there's any questions. There's a lot on the table this year, and there was a lot with Build Back Better and some of these changes that were going to happen. So we're definitely stay in touch if things do roll out, and as things do roll out, we're constantly coming to the table with webinars and information on some of the things that are changing, some of the things that you might want to consider. So if you do hear any news or you want to stay in touch, we have go to our website. You can sign up for our newsletter and stay on top of all the content that we put out there. So Kira, at this point, now that we have it open to questions, I don't know if there's anybody.
Yeah, there's no questions in the chat. I mean, in the Q&A today.
Okay. So yeah, of course, if you have any questions after the fact and want to reach out to me directly, my email is john, JOHN, @bautisfinancial.com, and I'd be happy to answer any questions you have. So thanks a lot for joining me, everyone, and I will see you all soon.